All right, so here's the big question. Is it qualified or is it non-qualified? My name is Jeff Miles. This is The Right Path to Retirement with financial advisor Jimmy Lin. He's the president and founder of Right Path Wealth Management. You can find him online at rightpathtoretirement.com, rightpathtoretirement.com. While you're there, make sure you subscribe to the podcast. And Jimmy, let's jump right into it. You know, I jump into retirement. I'm ready to just kind of like sit back, relax, live the life of leisure, kind of stick everything on autopilot. And then I have to start looking at the different forms of where I'm going to be getting my monthly income to basically live on now that I'm on autopilot. It's a lot more confusing than just sitting back and waiting for checks to come in the mail. You've got different types of accounts depending on how you set up, retirement when you were working. So you got a 401k, you've got Social Security, you've got, maybe some investment accounts over here that you'd been, maybe dabbling a little bit in the stock market, whatever it may be. Now we have to figure out how that money, when it gets distributed to me, it's qualified or non-qualified. What's the biggest difference between those two types of money?
Well, that's a common question. The IRS doesn't make it easy for us to understand this stuff. But yeah, at a basic level, a qualified account, you're going to think about any type of retirement account you have. Yeah. So it could be a 401k, a 403b, a TSP, a traditional IRA. These qualified retirement accounts, they just there's certain embedded tax advantages that the government has given. So as an example, we talked about before is, when you make a contribution to a qualified account, depending on the type of account, you may get a certain type of tax advantage. So for a 401k, the tax advantage is that you get a reduction in your salary that you're reporting to the IRS. So you're not paying taxes in that year that you earn that money because that contribution reduced your salary. And also the gains on that account are going to be deferred. So you can have hundreds of thousands of dollars of gains over a 20, 30-year period, and you haven't paid taxes on any of that because it's all deferred until retirement when you start to pull that money out. A Roth IRA is another type of qualified account that has a different tax advantage. You're going to be paying taxes on the money that you put into that, but it is going to grow tax-free. So they have different tax advantages, but essentially the first aspect of a qualified account is that there is some sort of tax advantage. Then they also have things like contributions limits. You can only put in a certain amount. Sometimes it's based on your income, and they have different rules on when you can access the money. So those are the kind of different features that make something a qualified account. Now, when we talk about a non-qualified account, I would just tell people that's money that is outside of a retirement account. So, Jeff, if you have a Fidelity account, for example, just a brokerage account, or you and your wife have a joint account and you are, buying those aggressive tech funds that you're so fond of, right?
Right.
That's going to be a non-qualified account. So it doesn't have the same rules that are in place that I described. So, for example, you can contribute as much as you want into a non-qualified account. There are no rules on when you can access the money. You could put it in today. You can get, double your money in 2 years and then pull it out. There's no 59.5 rule in place for a non-qualified account. And I think both are important. So in a balanced retirement plan, having those qualified dollars, but also having that non-qualified bucket of money is advantageous for a couple different reasons, right? Because there are advantages to those non-qualified brokerage accounts. When you have gains, you pay capital gains rates if you've held it for over a year. So for anyone that kind of understands the tax code, capital gains rates are typically going to be less, generally speaking, than ordinary income rates. So imagine you're retired, you're 65 years old. Jeff, we've talked about this before. Whenever you distribute money out of those qualified retirement accounts, if it is a tax-deferred account like a 401k, you're going to be paying ordinary income tax on that. And it's basically whatever the tax rates are at that time that the government implements. Well, if you have this non-qualified bucket of money, you can pull money out of that, and generally you're going to be paying less in taxes. So you can start figuring out where your tax rates are, and it may make sense to pull out of a non-qualified account. And we the other advantage, and this is really important for some people that maybe are not quite 59 and a half, where you can generally access these tax deferred accounts, is that there is no age limit on when you could pull out of your brokerage accounts. So there is an advantage to be able to kind of bridge the gap if you want to retire early, or if you just need access to funds. So what we talked about before, having the diversification of tax buckets as well as investment buckets. This is another example of that, is really just having those different levers that you can pull during your working years and then into retirement.
So it's interesting because, as we talked before in a previous episode about 401ks and, the fact that this is all money that as you start to take it out is now going to be taxed at income level, whatever that is. And so you kind of want to strategically take your monthly income from these accounts to put yourself in a tax bracket income wise, where you're hopefully paying the least amount in taxes as you possibly can. Whereas in these non-qualified accounts, say a brokerage account or something like that, so you're not having to worry about whether or not that money goes against income or goes towards an income to raise taxes and put you in a different, tax income bracket. Is that the right way to look at that from a distribution aspect?
It absolutely is, because, the distribution phase of retirement is critical in being efficient with making sure you preserve your assets, right? The less you pay to the government, obviously, is the more you have in your pocket to take that vacation or pick up that new hobby. And so we look at everything when we're sitting down with our clients and creating a distribution plan, is what is the most tax efficient way and what order should you be distributing your assets. And so if somebody needs $100,000 in retirement, they may want to take out, after they have their Social Security benefits, they may take out, say, $50,000 from their 401k. That money is going to be distributed at ordinary income rates. But they need another $20,000. It may be more advantageous for them to then take money out of that brokerage account, that non-qualified account, because that money is going to be taxed at capital gains rates, which is typically, in many cases, going to be less than ordinary income taxes. And then, of course, when we take diversification of your buckets of money a step further, it's having that Roth IRA account, right? Because that Roth IRA account is going to be completely tax-free. You're not going to get taxed on ordinary income, and you're not even going to have capital gains taxes on that. So having those three buckets of assets, of qualified and non-qualified money, really gives you the opportunity to control how much you're going to pay in taxes. Because the opposite of having a tax plan and kind of controlling what you're going to do is just kind of blindly taking money out. And I could say in most cases, if you're just blindly taking money out, you're not being the most efficient, which the bottom line to that is you're probably paying more in taxes than you should be.
Okay, so we know that with a 401k, you're not really allowed to start taking that money out until you're 59 and a half, correct?
Correct. That's absolutely right.
And then your RMDs on a 401k account, which is a qualified account, those RMDs kick in at what age? Is that 73? Is that correct?
Generally 73. The rules are changing on that, but for most people out there, it's 73.
Okay. So now I'm looking at this from if I'm sitting here and I've got a very large amount in my 401k and let's say I'm 60 years old, I've basically got about 12 or 13 years before I actually have to start taking money out of this 401k. So I don't have to use that yet as income, correct?
Yes, that's correct. So that would be an opportunity sometimes where you can pull some of that money out and do a Roth conversion strategy, is what a lot of our clients are doing, where they don't have to pull that income out yet, but it may make sense to show some income by distributing some of that money out between the time you retire and the time that the government's going to start forcing you to take some of that money out. You can control your tax bracket. So you could say, I see, I'm going to take a certain amount to put me to the 22% tax bracket, because that's still reasonable in our current tax environment. What are those tax rates going to be 10 years from now? So if you want to kind of control some of that, you can start taking some of that money out, and it could be part of your income, but more importantly, it'll be part of your tax plan.
Okay, so let's just say that the tax code changes because, I mean, hey, listen, we're in an election year right now. This could change pretty quickly. So let's say that, as we get closer and we usually know, and tell me if I'm right or wrong on this, don't we usually find out what next year's tax rates are going to be the year before? At some point in time?
Yeah, so we know what the tax rates are going to be this year and next year because of the Tax Cuts and Jobs Act.
Right.
But what we don't know is the Tax Cuts and Jobs Act actually expires at the end of 2025. So in 2026, we don't know. We technically know what it's going to be because it's going to be what the rates were in 2017, which are all higher than what our current tax rates are. So unless Congress acts, we do know that taxes are going to go up in 2026.
So if I know that, right, then it might be advantageous of me to take out a certain amount based off of today's current tax rates, like right now, before I get to 2026 to lower when I need to take money out in 2026, let's say, to move over into another account for tax purposes. Am I looking at that correctly at all? Or?
You know, Jeff, what I love about you is you make it so simple, which is 100% right. Because common sense tells you right, that there was some legislation called the Tax Cuts and Jobs Act. And what it literally did was from 2018 to the end of 2025, it reduced our tax rate. That is undebatable, right? Our tax rates are lower. What we also know, 100% fact, is that unless Congress acts, the tax rates will go back to what they were starting in 2026, which were higher. All of this is undebatable. So what you're saying is very simple and very true. If taxes are lower right now, wouldn't it make sense to move some of my money from that 401k or traditional IRA, shift it over to a Roth IRA, pay the taxes today because I know that the tax rates are lower than they were in 2017 or where they should be in 2026. So why not pay less in taxes? In theory, taxes are on sale, right? So being able to convert this year and then also next year could be to your advantage. And it sounds so simple, but some people, when they look at that situation, they got to be convinced. But once you kind of break it down, numbers don't lie, right? And you're 100% right. Is that as simple as it sounds? That for many, many people, not everyone, but for many, many people, that is the exact strategy that could save them in lifetime taxes.
Here's one thing I know, Jimmy, is that when the law is the law, and I know that math is math, and math will never change. So if I'm using a law over here, knowing how the law works in time, so to speak, and when the expiration of when that law is, and I understand that math will never change, and you put those two things together, I mean, I look at it and I say, okay, so right now, and I'm just using hypotheticals. I want people to know this is not actually what the tax code is. But right now, if I take $100,000 out of my qualified account over here, this 401k that I have, let's say, and it's taxed at 22%, but I know that, in 2017, $100,000 was actually taxed at 28%, then I'm going to make sure to take out all the way up to like what that 28% number is in the current tax code so that I'm maximizing the potential of, that tax burden on the overall money that I have in my 401k. Did I get that right?
You did. You should be in my seminars explaining this to all the attendees because you got it. That's the exact way that I explain it. And I think that, we laugh about it because it just sounds too simple, right? But again, numbers don't lie. The law doesn't lie. And so again, things could change in 2026, but we have to make decisions based on the information at hand. And based on everything that you described in your scenario, you are going to pay less taxes on that money now than you will in 2026. So when taxes are on sale, we're always looking for a good deal, right? Look at Black Friday. Oh yeah. Look at the Cyber Mondays that Amazon has and the internet has. We are a country that we're looking for a deal. Well, the largest expense that most people have in retirement is going to be their tax bill. So if we have a sale on taxes right now, wouldn't that be the thing that you wanted to line up for? Instead of lining up for that $200 big screen TV at Walmart, you want to line up for this tax cut that we know is going away. So that's the thing, is that if you know what's going on right now and you know that this is a large expense, it's something that most people should investigate. And for many out there, there will be a financial advantage to implementing some type of tax plan for those qualified accounts right now.
Here's the thing, Jimmy, is that I know that for so many people, a lot of this really boils down to what your needs are, what your monthly expenses are, and things like that, which is literally just such an important thing for so many people who are retired. I feel that way, but then I also feel one other way. And there may be people listening to the podcast right now that may feel the same way that I do. Are you ready? And that's that, well, this is kind of a game that I'm playing that I want to win. And it feels like that the way that we're describing this right now is that this is a way to win. It's kind of a way to kind of beat the system, so to speak, because there are other parts of this that when I look at it, and I can take it one step further with just the math aspect of it as well. And that is, yeah, if I'm going to take a little bit more money out of my 401k this year to put it into something like a Roth account, and I know that I'm going to bump right up into that next tax bracket for the income purposes of what's going to be taxed on that 401k money moving over, I'm not only saving on what would be next year's tax implications because of what we know what the 2017 numbers were, but I'm also looking at it from a perspective of inflation. And I'm almost kind of beating inflation by moving money before it's taxed if taxes are going to be going up.
Yeah, that's a great way to look at it, and it's true. You know, you're looking at your whole retirement, and it's not a game. Obviously, it's our lives, right? But when you look at it, games are strategic, and your retirement is strategic, right? So you could play a game and just go about your business, or you can be thoughtful about it. And when you're thoughtful about it, then you can actually just take advantage of the tax code. So that's what it's out for. There's a difference between people that will be proactive and look at a situation and take advantage of the situation. You know, and there's different scenarios, right? If the market is down, people take advantage of a down market by investing. Well, when taxes are down, people take advantage of the tax market by doing these conversions. So it's really just looking at scenarios and being able to be proactively maneuver within the rules that are at play right now. I think that's 100% the way to look at things is you're playing this game, and if you're going to play a game, you're going to play to win, right? And that's what I tell my clients all the time.
Yeah. And, you know, to kind of add to that, Jimmy, and this is a big part of especially the time of, the season that we're in right now, and the fact that we're in election year. So we know that taxes are going to be something that's going to be a big conversation around this particular election and getting into 2026. But once the election has happened, and once we know what's going to be happening from that point forward, the emotional part of the election as it pertains to taxes is then over, so to speak, because we're all going to be living according to whatever the current tax code is, regardless of who put it in place. We all have to abide by whatever those particular tax laws are. And again, those tax laws, they're not an emotional thing against you, and neither is the math. And so you do have to look at it from a position of, okay, I need to be strategic here. And the emotional side of, I'm sure many people, when they come to talk to you, Jimmy, they're emotional about a lot of things as it pertains to their retirement. As I'm not saying they should be, but as it's just human nature to feel that way. It's your money. You work so hard for it. But then when it comes to the point of actually making the decisions, Jimmy, that's where you kind of step in and you kind of take that non-emotional part out of it and you put it into that really strategic plan, which to me, that's the whole idea, right?
Correct. Yeah. I mean, especially as you described it in an election cycle, emotions are much, much higher. And we do have to kind of take a step back, because when you're in an election cycle, all the candidates are going to tell you things that you want to hear, right? Everybody's taxes are going to go down. But after the emotion is subsided, we figure out who's going to lead the country for the next 4 years.
Yeah.
Then the fallback we have are, what are the current rules, right? I don't care what people told me when they were trying to win my vote. I care about what the actual law is. And we know what the rates are right now. We know what the rates are going to be next year. and we know what legally they're supposed to be in 2026. So what I always tell people is if you do nothing, even though you have all the facts at hand, what you're kind of doing is just kicking the can down the curb, right? Or burying your head in the sand, because you know that you are going to pay taxes on this money. That is a fact. The IRS has never I don't see a scenario where the IRS just sees $2 million in your tax deferred account and says, you know what? We're going to be nice this year, and you can just pull this money out. No,
you've been a great guy.
To pay taxes, right? You've been a great guy, and so we're going to reward you. That's just not a scenario that I could ever see. So we can't bury our head in the sand. We can't kick the can down the curb, because it will be literally a tax bomb. And it's funny. I feel like there's a common theme in many of our podcasts, Jeff, and it is surrounded around taxes. But the reason for that is really because of the time we're in right now. We're in a time where we're in really one of the lowest tax environments we've ever been in. And there is an end date to this. And that's why, if our listeners are thinking, well, these guys talk about taxes a lot, it's because it's that important. Investment and growing your assets are important because that grows your money. But you know what else grows your money? Saving and taxes. And so I think that, just making sure that you have a plan in place, whatever that plan is, make sure it's thoughtful. And like I said, in the environment that we're in right now, you wouldn't be responsible to yourself if you at least didn't explore a tax strategy that could save you hundreds of thousands of dollars over your lifetime.
Get in touch with Jimmy Lin, of course, the president and founder of Right Path Wealth Management at rightpathtoretirement.com. Once again, rightpathtoretirement.com. My name is Jeff Miles. This is the Right Path to Retirement podcast. And Jimmy, thanks again so much for all the insight. I'm hoping that people who are listening to this podcast, at the very least, go to the website so they can get more information and really become educated on some of these things that we take, granted that we think it's too simple, and it's actually more complicated than you think.
Perfect. Thanks a lot, Jeff.
Insurance products are offered through the insurance business Right Path Wealth Management. Right Path Wealth Management is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Right Path Wealth Management are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Right Path Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained by sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Right Path Wealth Management.